Morning. Thank you very much for joining us today for our 2022 Corporate Finance Disclosure and Energy Matters Information Session. My name is Denise Weirs. I'm the Director of Corporate Finance here at the ASC, and I'm pleased to be moderating this morning's session. That means I've left the tough stuff for our team. We have three parts to today's session. First, we're going to hear from Chris Andrews, Bhavani Sankar, and Nicole Law, three of the securities analysts and CPAs in our corporate disclosure and financial analysis team. Chris and Bhavani will share with you the findings outlined in the Corporate Finance Disclosure Report that we published in December. And that's really the product of the team's most recent review of continuous disclosure documents by Alberta reporting issuers. They'll provide guidance on areas where there were notable disclosure issues. Nicole will then be joined by Anne-Marie Landry, our Associate Chief Accountant, and they'll address some of the recurring questions that are arising in relation to National Instrument 52-112. That's the NonGAP rule that just became effective in August. Following their presentation, we'll have an opportunity to take audience questions. So if you have questions, please use the Q&A section. It's at the bottom middle of your screen, and you can submit them there. We'll then move into our second session, in which Tanya Fleming, a senior member of our corporate finance legal team, will provide an overview of proposed National Instrument 51-107, Disclosure of Climate-Related Matters. That proposal, of course, is intended to respond to requests from both investors and issuers for more standardized and comparable climate-related disclosure. However, we recognize that the proposal could represent a significant new compliance effort for many issuers. So your feedback can help to ensure that the requirements are appropriately calibrated and the timelines achievable. We recently extended the period for submitting comments out to February 16th. So if you haven't yet had chance to comment, there's still time, and we encourage you to do so. Tanya will be joined by another member of our legal team, Amanda Kuzinoris, for the Q&A session. We'll then have a short break and return for our third session, during which Craig Burns, manager of our energy group, will provide an overview of the results of the energy group's review of oil and gas disclosure under National Instrument 51-101. The oil and gas industry is responding to new demands relating to ESG disclosure and the push towards net zero. Similarly, our focus is also expanding to look more broadly at the energy sector and these other matters. And this broader focus is reflected in the expanded content of the newly titled Energy Matters report. And it'll be the focus of the remarks by Ramsey Yoon, one of the petroleum engineers in our energy team. So the sessions this morning, they'll highlight some of the key new regulatory initiatives here at the ASC, non-GAAP disclosures, climate-related disclosure, and the ASC's expanded focus on all things energy. However, I thought maybe I should just take a moment to also mention some of the other important regulatory initiatives that we've been focused on. And I think it's probably easiest to think of them as sort of three main themes. First, we continue to devote significant effort to looking at ways that, while still protecting investors, we can reduce regulatory burden for reporting issuers. You'll probably recall that we revised rules in relation to business acquisition reporting and at the market distributions. In addition, we've made significant progress in a number of other matters, and we hope to advance those further this year. For corporate issuers, one of our priorities is revising our rules to allow them to distribute their continuous disclosure documents and prospectuses through electronic access, rather than requiring them to be delivered. Another priority, a project the OSC is co-leading, is consolidating and streamlining the annual and interim disclosure requirements under National Instrument 51-102. That proposal was published for comment in May. We've been focusing as well on harmonizing across the CSA and clarifying when a business is considered a primary business under the prospectus rules. Proposals relating to that were also published for comment in May, and we expect to be able to publish the final guidance this year. And we've been looking at ways to reduce the regulatory burden in connection with financings. We published proposed amendments to National Instrument 45-106 in July that would introduce the listed issuer financing exemption. It would allow smaller financings of free trading securities by listed issuers without requiring a prospectus. For larger issuer financings, in December, we adopted across the country harmonized interim blanket orders. Those will allow well-known seasoned issuers to access the markets more efficiently by exempting them from certain requirements, including the need for a preliminary prospectus receipt when using the shelf prospectus system. And efforts are ongoing to turn that into a permanent rule amendment. We've also had various initiatives underway to reduce regulatory burden for investment funds, such as streamlining and consolidating the AIF and simplified prospectus, and codifying various routine discretionary relief, for example, relating to notice and access, to proxy materials, and eliminating certain approval requirements in connection with things like changes of manager or custodian. A second sort of main theme or focus area for us has been looking at ways that, while we can still protect investors, enhance access to capital for startup and early stage issuers. And really, these are efforts continuing on from our consultation a few years ago on energizing Alberta's capital market. Our efforts are part of the broader efforts to strengthen and diversify the economy in Alberta. And in that regard, together with our CSA colleagues, we adopted the National Instrument 45-110. That's the startup crowdfunding, registration, and prospectus exemption. And it now allows financings of up to $1.5 million in a 12-month period. But locally here in Alberta, we've been looking at what more we can do. And with our friends in Saskatchewan, we've adopted 2 new prospectus exemptions. In March, we adopted Blanket Order 45-538. It's called the Self-Certified Investor Exemption, and it allows investors who don't have the income or assets necessary to qualify as accredited investors to invest alongside accredited investors, provided that the investor certifies to having certain education or experience and is aware of the investment considerations related to early stage financing. And second, in September, we adopted Blanket Order 45-539, small business financing. It allows issuers in Alberta or Saskatchewan to raise up to $5 million in those provinces using a streamlined offering document. For financings of less than $1.5 million, similar to crowdfunding, there's no requirement for financial statements. For financings above that amount, financial statements are required, but they can be reviewed rather than audited and can be prepared using a modified regulatory standard that's essentially private company GAAP. And the investment limits increase with that additional disclosure. And lastly, the third main theme underpinning some of our regulatory initiatives is related to ESG, environmental, social, and governance matters. So focusing not just on the proposed climate-related disclosure already mentioned, but also on broader ESG considerations. In that respect, we've continued to monitor and report on women in director and executive officer positions, publishing the latest report in November. And more recently, we've been consulting with stakeholders respecting broader diversity disclosure, including holding a public roundtable session with the Institute for Corporate Directors here in Alberta in December. In addition, we've been monitoring broader ESG disclosure and assessing potential greenwashing concerns. And in that regard, just yesterday, we published guidance for investment funds with respect to ensuring compliance with existing securities law when describing ESG-related investment objectives and strategies and similar matters. So before I turn it over to the team for the more substantive discussion, I just should take a moment perhaps to reiterate that the purpose of these sessions is really to be helpful. We're very interested in your feedback on whether we're achieving that goal and what changes might better do so. There'll be a survey following today's session that's particular to this event. And in addition, we're interested in your feedback more generally. To that end, we'll be conducting further outreach later this year to hear from you on other ways we can best engage with you. So thank you for your time, and I guess on with the show.
Good morning, everyone, and welcome to the Alberta Securities Commission 2022 Corporate Finance Information Session. My name is Chris Andrews. I am a securities analyst in corporate finance, and I will be presenting today along with my colleagues Bawani and Nicole. Our agenda today covers 6 topics, which we intend to go over in the next 50 minutes, and we'll leave a few minutes at the end for questions. Questions can be submitted through the chat function. For those looking to earn professional development credits, a link to a survey will be provided at the end of the presentation and also sent to participants in an email after the presentation. Upon successful completion of the quiz, a CPD certificate will be provided. Stay tuned in. The first topic we are going to cover is the discussion of operations in the MD&A. The MD&A provides management an opportunity to discuss how the issuer performed during the period covered by the financial statements, including its financial condition and future prospects. We continue to identify the discussion of operations in the MD&A as an area of an improvement, as this disclosure commonly does not provide sufficient depth of discussion with respect to planned activities or for period-over-period analysis. A balanced discussion of financial performance and financial condition provides transparent communication with investors and helps them gain an understanding of the overall business. The topics we will cover on the discussion of operations are the focus on material information, providing a detailed analysis, and significant project disclosure. The MD&A should provide a robust and in-depth analysis of the current period financial performance, financial condition, and cash flows, with a focus on disclosure of material information. Information is material if a reasonable investor's decision whether or not to buy, sell, or hold securities is likely to be influenced or changed if the information in question is omitted or misstated. This is required and expected to be updated each disclosure period. It is not sufficient to roll forward the prior period disclosure into the current period document. One component of the discussion of operations is to explain in detail the nature of and reasons for changes in an issuer's performance. The analysis should provide investors with an understanding of current trends, events, transactions, and expenditures. When an issuer provides period-over-period analysis, it is important to quantify material changes and provide discussion that clearly explains the reasons for the change. Simply disclosing the amount of change in a financial statement line item period to period and using boilerplate language is not sufficient. For example, when discussing revenue variances, issuers should give full discussion and analysis of the elements affecting revenue, such as price and volume, and why those underlying variables have changed. When discussing expense variances, providing a meaningful analysis and discussion of the material components of expenses, including offsetting variances, will provide investors with an understanding of the operations. This research and development disclosure from an MD&A did not meet our expectations. The deficiencies that we identified were that the analysis did not provide details for the change, such as quantifying the material components of the R&D expense, offsetting variances, the salary increase and the raw materials decrease were not discussed in sufficient detail, and given the deficiencies identified, we requested that the issuer amend and refile the annual MD&A. The above R&D disclosure in the revised and refiled MD&A did meet our expectations. The change in expense was fully quantified for dollar value and percent change. The offsetting variances were discussed in sufficient detail to allow an investor to fully understand the current period performance. The stage of development for Project A is more clear, and the future R&D costs are disclosed, as well as the period in which the issuer expects to reach commercialization. The MD&A form also requires issuers to describe their significant projects that have not yet generated revenue, including the overall plan for the project, the status of the project relative to that plan, expenditures made to date, and how those expenditures relate to the overall anticipated costs of the project. This disclosure is required for all issuers, irrespective of the industry they are in. The Alberta market has seen an emergence of technology-based issuers, from consumer and industrial end products to parts and component manufacturers supporting a broad range of industries. Early stage and developing companies who are technology-based and have not yet generated significant revenue from projects are required to provide additional disclosures on their projects in the MD&A. We have observed issuers not discussing project plans in sufficient breadth and depth, and although the current period expenditure is often disclosed, there's a lack of disclosure on how the current expenditures impact the timing and remaining costs to take the project to the next stage and ultimately reach commercialization. This significant project disclosure did meet our expectations. Please note this is not full disclosure, and see the corporate finance report for the full disclosure details. In this example, both qualitative and quantitative disclosures were made. The qualitative R&D disclosure on this significant project did meet our expectations in that the overall plan for the project is discussed in sufficient detail, and the status of the project relative to that plan has been disclosed. The accompanying quantitative R&D disclosure on this project also met expectations in that the expenditures made to date have been disclosed, and how those expenditures relate to the overall anticipated cost of the projects are both included in the issuer's disclosure. Readers have a clear understanding of the issuer's significant projects and can make an informed investment decision regarding the issuer's future prospects and potential. When making significant project disclosure, preparers should ask themselves the following questions. Has each significant project been described in enough detail to enable investors to understand our plan for the project and the status of the project relative to the plan? Does our explanation of project expenditures clearly disclose costs incurred to date compared to estimated costs? Has a clear timeline been provided, including where we are in that timeline and when we anticipate being complete? Have we explained where we anticipate obtaining funding for the project if required? And if applicable, has a breakdown of the material components of research and development been disclosed? The next topic we will cover is selective disclosure. In addition to reviewing the documents an issuer is required to file under securities legislation, we may also review and assess voluntary disclosures to ensure compliance and consistency. We continue to see an increase in potentially misleading disclosures being presented to investors, which is generally in the form of inconsistent disclosure between voluntary and non-voluntary documents and may be considered promotional in nature. Voluntary disclosure documents are typically published on websites or on social media platforms and include documents such as corporate presentations, sustainability reports, public surveys, and corporate citizenship reports. While the information disclosed in these voluntary documents may be useful to investors, we have observed inconsistencies between voluntary disclosure documents and regulatory filings, which can be potentially misleading to investors. Corporate presentations often include disclosures that are not included in regulatory filings, or the disclosure within the presentation is not updated in a timely manner when facts and circumstances have changed. We generally presume that information disclosed in an issuer's corporate presentation is material. We expect material information that is disclosed in a corporate presentation to also be disclosed in required filings, generally in the MD&A. Including consistent disclosure in the MD&A helps issuers avoid the appearance of making selective disclosure. In this disclosure example, contained in a corporate presentation, did not meet our expectations. In the first disclosure example, staff noted that the current period MD&A provided no disclosure with respect to the capital resources and the $1 billion growth pipeline, nor was the status of the 12 shovel-ready, near shovel-ready projects discussed. We would expect disclosure on these significant projects to be made in the issuer's MD&A. In the second disclosure example, the targets did not appear to have been communicated, as we were unable to find them in any of the issuer's required or voluntary disclosures. As the targets were not disclosed in any document, we found the disclosure to be incomplete and promotional in nature. Given the deficiencies identified, we requested the corporate presentation be removed from the issuer's website until the issue was resolved. As mentioned, we generally presume that information disclosed in a corporate presentation is material. As such, it should also be disclosed in the MD&A, which requires that information material to an issuer be disclosed. In addition to inconsistencies between voluntary disclosure documents and regulatory filings, we've also encountered inconsistencies between disclosures and required reporting documents, such as technical reports. For example, oil and gas issuers are required to file technical reports in accordance with National Instrument 51-101. We've observed issuers identifying material future development costs in Form 51-101-F1 that exceed or do not align with the liquidity and capital resource disclosure in the MD&A. Additionally, the net present value of reserves disclosed in Form 51-101-F1 is sometimes lower than the related assets carrying value disclosed in the financial statements, without accompanying impairment analysis and disclosure. Staff note that if an issuer is not able to expend the required future development costs per the reserve report, its ability to realize the net present values of cash flows in the reserve report is jeopardized. The next topic we will cover is promotional disclosure. Promotional disclosures regarding business activities and future prospects are often observed in news releases, the MD&A, corporate presentations, and on social media platforms. Promotional disclosures tend to be forward-looking in nature and often do not contain the required material factors and assumptions to support such disclosure. With the emergence of clean and green technologies and processes, disclosure made in this area can be challenging to verify, and it is often unclear if the disclosure is supportable. We remind issuers that with increased access to data and information online, it is important to ensure that all manners of public disclosure be factual and balanced. Further guidance is provided in CSA Staff Notice 51-356, Problematic Promotional Activity by Issuers. Next, we will look at some examples of promotional disclosure. An area of focus for staff on promotional disclosure has been the disclosure of addressable markets. We have concerns that promotional and problematic disclosure may artificially increase an issuer's share price and trading volume, which undermines the integrity of the capital markets and puts investors at risk of harm for making a misinformed investment decision. We have observed issuers with new product lines or operations that have not recorded significant revenue disclose the potential future revenue expected from partnerships and alliances without providing supporting facts and sources. In regards to the first disclosure example, despite the overall market demand for the partner's products, the issuer's product relates to integrating a component. The addressable market potential for the issuer was significantly less than the overall market for its partner's products, making this disclosure potentially misleading. In the second example, the required material factors and assumptions to support the production target of 800 were not disclosed. Also, the timing and steps required to reach the second year post-validation is unclear. Another area of focus on promotional disclosure has been the disclosure of potential future orders. In regards to the first example, this statement implies that the issuer has executed a purchase order with a partner, but upon further inquiry, we determined that no such agreement had been executed. Additionally, as the issuer has not yet generated revenue, this would be a milestone event that could artificially inflate the issuer's share price. In the second disclosure example, the steps required to obtain the necessary permits and approvals were not disclosed, and there was no accompanying disclosure made in regards to entering a new foreign market. Upon further inquiry, it was determined that the sales agreements related to countries in which the possession of cannabis is illegal, and that these countries had no plans to legalize cannabis in the foreseeable future. Staff have also identified promotional disclosure in the form of potential sales. In the first disclosure example, the issuer failed to disclose that franchise-wide sales were not the same as revenue recorded in its financial statements. The 2.5 million figure was a summation of all retail locations, and not the franchise royalty revenue earned by the franchisor, in accordance with IFRS, which is materially lower than the franchise-wide sales. Also, we considered this measure to be a non-GAAP financial measure, which was not appropriately defined, labeled, or reconciled in the MD&A as required. In regards to the second disclosure example, we are of the view that this disclosure was a material financial outlook, as it gives guidance to investors of the amounts of revenue expected to be earned within a certain time frame. As such, it must comply with the disclosure requirements of Part 4B of National Instrument 51-102 and include material assumptions and risks. It was also unclear what was meant by order book and whether this represented contracted sales or was an internal forecast. We remind issuers that if actual revenues earned materially differ from forward-looking disclosure, such as a material difference in the amount or the timing of revenue, then subsection 5.84 of National Instrument 51-102 would require disclosure and discussion of the material difference. Staff are seeing an increase in the frequency of positive environmental disclosures being made by issuers, which may be considered greenwashing when it is promotional in nature. So what is greenwashing? Greenwashing is the process of conveying a false impression or providing misleading information about how a company's operations and products impact the environment. Greenwashing is considered an unsubstantiated claim regarding a company's operations and products, which investors are not able to substantiate or verify. The publication of sustainability reports disclosing environmental, social, and governance impact is becoming more widespread. These reports usually describe operational performance in the context of clean and green production, such as achieving net zero emission targets or a carbon neutral position. While positive disclosures regarding an issuer's ESG performance are not prohibited, Material factors and assumptions used to support the claim must be disclosed. We have observed issuers including unsupportable disclosures in these reports that appear promotional in nature, as they do not contain the related material factors and assumptions. The following disclosures were identified by staff and were considered to be greenwashing in nature. In the first disclosure example, the actual scores were not disclosed, and it was unclear what standards the scores were based on, or the framework employed by the national newspaper. In the second disclosure example, there was no supporting disclosure to indicate how the zero emissions energy project would be achieved and where the company is in respect to its development plan. The issuer did not publish a sustainability report, nor did it publish any related emissions data, which makes it virtually impossible to verify the claims. In the final disclosure example, there was no accompanying disclosure on how the issuer was in fact carbon neutral or how its operations produce clean and sustainable energy. The accompanying sustainability report was outdated and had not been updated for the current period. Lastly, as the framework was not disclosed, it is unclear what standards were followed, such as those of the Task Force on Climate-Related Financial Disclosures, the Sustainability Accounting Standards Board, or the Global Reporting Initiative. I would now like to pass the presentation along to my colleague Bhawani, who will be covering developments on primary business and business acquisition reports. Thank you.
Thank you, Chris. Good morning, everyone, and welcome to our next session on primary business and business acquisition reports. When an acquisition is made or proposed to be made, it is very important for a reporting issuer to determine whether the acquisition constitutes a business. Remember, an acquisition may constitute an acquisition of a business for securities legislation purposes, even if the acquired set of activities or assets do not meet the definition of a business for accounting purposes. Consider what changes will result to the reporting issuer's business due to the acquisition or proposed acquisition. Why does it matter whether an acquisition is a business? It definitely matters, as this will determine what disclosures are required by the reporting issuer. Determine whether the acquisition is a business for the purposes of a continuous disclosure regime or for long-form prospectus regime, and in certain circumstances where the prospectus rules apply for filings such as information circular. This is an important step, as this will determine the required nature of disclosures by the reporting issuer. If a reporting issuer determines that the acquisition is a business for the purposes of a continuous disclosure regime, then the bar information that will also be presented shortly in this session will be more relevant. After the issuer has established the acquisition to be a business for the purposes of a long-form prospectus regime and for circumstances where prospectus rules apply, the next important step would also be to consider whether the acquisition will be considered an acquisition of a primary business. Question whether it would meet the reasonable investor test. That is, whether a reasonable investor would regard the primary business of the issuer to be the business acquired or proposed to be acquired. You may question, why does it matter whether the business acquired or proposed to be acquired is a primary business? It definitely matters. For full, true, and plain disclosures of the acquired or proposed business, and to understand its previous operational history. Determining whether the acquisition is a primary business will determine what disclosures are required to be made. Primary business is essentially the introduction of a new business into the company's ecosystem. There can only be one business story to tell. As such, this concept is generally applicable under the long-form prospectus regime and in certain circumstances where the prospectus rules apply for filings. Some important steps to consider for disclosures when an acquisition is a business under the prospectus regime. Item 32 of Form 41-101F1 applies for acquisitions determined to be an acquisition of a primary business. Item 32 must be assessed first before looking at item 35. Note, these sections are mutually exclusive, so you can't get caught under both sections at the same time. Where item 32 applies, that is primary business, then ignore item 35. Where item 32 does not apply, then a reporting issuer needs to assess whether it is a significant acquisition under item 35. These are essentially the bar rules. Where item 32 and item 35 does not apply, then no financial statements are required under those sections. However, a reporting issuer would need to assess whether additional information is required under section 5.7 of 41-101 CP for full, true, and plain disclosures. What's next? As indicated in our corporate finance report, more guidance is expected under National Instrument 41-101 CP as part of the CSA, reducing regulatory burden project relating to primary business. Stay tuned. The next topic that we will cover is business acquisition reports. As mentioned, if a reporting issuer completes an acquisition of a business under the continuous disclosure regime, then it must consider the business acquisition report requirements under Part 8 of National Instrument 51-102 for significant acquisitions. It is important for a reporting issuer to determine whether the acquisition is significant and if a bar is required to be filed. How is this determined? An acquisition of a business or related business is a significant acquisition if, for a non-venture issuer, at least two of the significance tests are triggered at the 30% threshold, or for a venture issuer, at least one of the significance tests is triggered at the 100% threshold. The corporate finance report includes the above helpful table listing the significance tests and also provides some useful tips with respect to bars. What information does the bar provide? It basically describes the significant business acquired and the effect of the acquisition on an issuer and provides historical financial information for the business acquired, and if required, the pro forma financial information for the combined entity. For the purposes of this presentation, we will take a closer look at the application of significance tests where there are multiple investments in the same business and related business. Refer to subsection 8.311 and section 8.312 of National Instrument 51-102. Consider whether a reporting issuer has a step-by-step acquisition, that is multiple small acquisitions in the same business, that when aggregated may constitute a significant acquisition. In such cases, the reporting issuer needs to aggregate multiple acquisitions in the same business for the application of the required and optional significant tests and determine whether a bar is triggered. Why does it need to be aggregated? This prevents reporting issuers from purchasing one business in piecemeal basis in order to avoid qualifying as a significant acquisition and tripping the additional disclosure requirements. In this example, the reporting issuer made an initial investment on March 2021, the second investment on May 2021, and the third investment on July 2021 in the same business. For the purpose of applying the required and optional significance tests, the initial investment and the incremental investments made during the same financial year must be aggregated and tested on a combined basis in order to determine whether a bar is required to be filed. In this next example, if the reporting issuer made one or more incremental investments in a financial year different to the financial year in which the initial investment was made, then the reporting issuer must apply the required and optional significance tests on a combined basis only for the incremental investments not reflected in the audited financial statements for the year end. What is an acquisition of related businesses? It means the acquisition of two or more businesses where the businesses are under common control or management before the acquisitions were completed. Each acquisition was conditional upon the completion of the other acquisition. or the acquisitions were contingent upon a single common event. In this example of related businesses, a reporting issuer acquires a business in April 2021 and plans to acquire a related business in February 2022. If the reporting issuer has not yet filed its annual financial statements for the year ended December 31st, 2021, at the time of the second acquisition, the acquisitions are required to be considered on a combined basis when calculating the significance test for the second acquisition. Let us look at this example where both sections apply. The filer was a December 31st year-end completed an initial acquisition in May 2021 that represented 60% of property A from vendor ABC. And the filer had the option to purchase the remaining 40% interest in property A in the future. The initial acquisition on May 2021 was considered a significant acquisition as it met two or more of the significance tests. As such, the filer prepared and filed a bar for the initial acquisition, including the required operating statements and pro formas. Later, in September 2021, the filer exercised his option to acquire the remaining 40% in property A and also acquired property B from the same vendor. Neither of these September acquisitions was significant on their own. However, subsection 8.311 of National Instrument 51102 required the incremental 40% to be combined with the initial acquisition, and subsection 8.312 of National Instrument 51102 required all three acquisitions to be considered in aggregate for the purposes of the significant test. Because they were all from the same vendor, common control prior to the acquisitions. As a result, both the incremental 40% and the adjacent acquisition would meet the significance test. To summarize, a reporting issuer needs to be mindful when they make an acquisition. Question whether it would be an acquisition of a business, whether they are in a prospectus regime or continuous disclosure regime, and question what disclosures would be required. I will now pass this along to my colleague, Nicole, who will be discussing the statement of executive compensation. Thank you.
Thanks, Bhavani, and good morning, everyone. This morning, I'm going to be covering three topics with you. The first one being the statement of executive compensation. We've seen an increase in the number of reporting issuers not providing appropriate or sufficient disclosures in relation to their executive compensation. The Corporate Finance Report identifies and discusses 6 key areas of improvement. This section of the presentation will take a closer look at a few of these areas. The first area we will cover is the completeness of benchmark disclosures. All reporting issuers that use a benchmark or peer group to determine compensation are required to describe the components of the benchmark group, including the companies and why the benchmark is considered appropriate. This example did not meet our expectations, as the reporting issuer states that it has used a benchmark to determine compensation for its named executive officers, but it did not specifically disclose and identify the competitors and peers that were included in the benchmark group and the selection criteria. Whereas this example met our expectations, as the reporting issuer clearly stated the benchmark and explained its components, including the selection criteria and the companies included in the benchmark group. The next area of focus we would like to highlight is performance graph trends not being compared to the compensation of named executive officers. Form 51102 F6 requires certain companies to provide a line graph showing the company's cumulative total shareholder return over the 5 most recently completed financial years. Companies are also required to discuss how the trend in the performance graph compares to the trend in the compensation to executive officers over the same time period. We often find that reporting issuers that are subject to the performance graph requirement do not fully satisfy this comparison requirement, as they fail to specifically discuss how the trend shown in the performance graph compared to the trend in the compensation of named executive officers over the 5 most recently completed financial years. To illustrate this, let's look at an example. This example did not meet our expectations as the reporting issuer has included the performance graph, but has not discussed the relationship between executive compensation and the cumulative total shareholder return over the 5 most recently completed financial years. Without providing context between the executive officer's compensation and the total shareholder return, the objectives of the performance graph are not met. Whereas this example met our expectations as the reporting issuer has specifically described the trend in executive compensation and how that trend compared to the trend in cumulative total shareholder return. Further, this example indicates that the two trends were related over the 5 most recently completed financial years. While not a requirement, we found that some reporting issuers provide an additional line item in the performance graph showing the trend of the named executive officers' total compensation over the same period. We found that this is an effective and meaningful way of comparing compensation trends with total shareholder performance when combined with a narrative discussion. The last area of focus we will cover is the disclosure of performance goals and targets. All reporting issuers that use performance goals or similar conditions to determine a component of total compensation are required to describe the performance goal, providing specific measures when appropriate. We often see reporting issuers not providing complete disclosure regarding the use of benchmarks and determining the performance goals. For example, this disclosure did not meet our expectations as the reporting issuer has stated that there were quantitative and strategic targets used to determine the short-term incentive plan for the named executive officers. Instead of stating that the named executive officer's target was 50% of base salary, the issuer should have disclosed the specific target that is being used, such as share price. I would like to point out that when disclosing performance goals, if a non-GAAP financial measure is identified as a target, that the non-GAAP financial measure would be in scope under the new National Instrument 52-112, but only if an amount is disclosed in the executive compensation disclosure. We will go through the new requirements of the non-GAAP and other financial measures in more detail next. This year, the CSA published National Instrument 52-112 non-GAAP and other financial measures disclosure. We know that this is an area where issuers have a lot of questions, especially if you're beginning to prepare your annual reporting documents. So we wanted to address some frequently asked questions that we have received. On May 27th, 2021, the CSA published National Instrument 52-112, which includes disclosure requirements for issuers that disclose non-GAAP and other financial measures on a voluntary basis. 52-112 became effective on August 25th, 2021, and can be adopted anytime after this date. Issuers are permitted to delay adoption for a certain period of time under the transition provisions set out in Section 13 of the rule. For reporting issuers, the rule only applies to the documents filed for a financial year ending on or after October 15th, 2021. Whereas with non-reporting issuers, the rule applies after December 31st, 2021. Issuers not yet subject to 52-112 should continue to refer to the guidance in Staff Notice 52-306, which will be withdrawn when transition to the final rule is complete. For example, a reporting issuer with a financial year ending on December 31st, 2021 will initially apply the rule to its 2021 annual period, either in the earnings release or the annual filings, whichever is filed first. We have been getting questions from reporting issuers about forward-looking information for fiscal years that fall after October 15th, 2021, and whether a forward-looking non-GAAP financial measure is subject to the new rule under the transition provisions. An example of this is when a reporting issuer with a September 30th year end discloses a non-GAAP financial measure on a forward-looking basis for the 2023 fiscal year in its Q1 2022 interim MD&A. As the transition provisions apply to documents filed for a financial year ending on or after October 15th, 2021, and the Q1 interim MD&A is not a document for a financial year end, this document, including the forward-looking non-GAAP financial measure, is not yet subject to the new rule. What issuers and documents are in scope under National Instrument 52-112? The instrument applies to all reporting issuers with the exception of investment funds, designated foreign issuers, and SEC foreign issuers. It also applies to non-reporting issuers when a specified financial measure is disclosed in a document made available to the public relating to filings such as an initial public offering, offering memoranda, or documents submitted to a stock exchange in connection with qualifying transactions, reverse takeover, change of business, listing applications, significant acquisitions, or similar transactions. 52 and 12 covers all documents made available to the public, as well as other written communications that are intended to be or are reasonably likely to be made available to the public, such as websites and social media platforms. However, certain disclosures are exempt from the requirements of the instrument, such as disclosure required by National Instrument 43-101 for mining issuers and 51-101 for oil and gas issuers. But oil and gas issuers should be aware that the exception only covers required disclosures and not those supplementary measures disclosed as oil and gas metrics under Section 5.14 of National Instrument 51-101. The instrument sets out the specific disclosure requirements for non-GAAP financial measures, non-GAAP ratios, and other financial measures, such as total segments measure, capital management measures, and supplementary financial measures. Collectively, these measures are referred to as specified financial measures. Each measure has a different meaning and specific disclosure requirements. When determining what type of specified financial measure you have, you will want to complete your assessment in this order, beginning with the non-GAAP financial measures. We have heard that the flowchart in the 52-112 companion policy is a good tool to use to help categorize these measures. But we also understand that this is an area where issuers have a lot of questions. So let's bring in our subject matter expert, Anne-Marie, to discuss. Anne-Marie, have you received any questions around the process for figuring out the type of financial measure?
You're right, Nicole. We have been getting questions from issuers about their specific measures and what category they fall into. And what we are telling them, as you just highlighted, Nicole, is that issuers should first look to the non-GAAP financial measure definition. And as part of the non-GAAP financial measure definition, one of the easiest things to first look at and to assess is if your measure has been disclosed in the financial statements. And what I want to highlight here is that the financial statements include the primary financial statements as well as the financial statement notes. Another item to highlight is that in the definition is that the measure's composition excludes or includes an amount from or in the measure disclosed in the primary financial statements. And we've been getting questions on this, specifically on line items or disaggregations of line items. And to respond to some of these FAQs, I have a few examples. The first, if revenue dollar per BOE measure is calculated using the revenue line item extracted directly from the statement of income, then this measure is not a non-GAAP ratio and would only be subject to the labeling and composition disclosure requirements for specified financial measures in Section 11 of the rule. For most oil and gas issuers, and looking at a typical MD&A, you have already provided the disclosure necessary under Section 11. The title of the measure, revenue per BOE, is self-explanatory. And also many of you have already provided a description of BOE per day and how it is calculated. Beyond this, we wouldn't necessarily see any further disclosure required under Section 11. Next, revenue presented on an FLI basis. Again, if this is revenue as presented in the primary financial statements, adjusted only for assumptions about future economic conditions and courses of action, then this is not a non-GAAP financial measure and there would be no disclosure required under 52-112. However, this measure would be subject to the FLI disclosure requirements in 51-102 as indicated on this slide. And in the first and the second examples, if the revenue measure is adjusted in any way, or the measure has not been calculated in accordance with the accounting policies used to prepare the revenue line item presented in the primary financial statements, then this measure's composition does exclude or include an amount from or in the measure disclosed in the primary financial statements. And this adjusted measure would be a non-GAAP financial measure subject to the disclosure requirements in Section 6 for historical or Section 7 for forward-looking measures. The last example is on questions we've been getting on disaggregation or what would be considered component information. The example on this slide is a recent example received on whether F&D capital would be a disaggregation of a line item or a non-GAAP financial measure. In this case, As you see, F&D capital is disaggregation of the financial statement line item, capital expenditures on the statement of cash flow. As such, this measure would not be a non-GAAP financial measure, and only the labeling and composition disclosure requirements in Section 11 would apply. Another question we have been getting is on qualitative disclosure, where a measure is simply described, but no corresponding numerical amount is disclosed. The 52.112 rule applies to specified financial measures with the emphasis on the term financial. So if there is only qualitative disclosure without a corresponding numerical amount, there is no resulting disclosure requirements under 52.112. Nicole, as you talked about executive compensation earlier on in today's corporate finance presentation, can you expand on these next two examples for me?
Yes. As discussed earlier, a specified financial measure that is quantified in an issuer's executive compensation disclosure is subject to the requirements under 52.112, but only certain disclosure requirements apply. The issuer must identify the non-GAAP financial measure and provide a quantitative reconciliation of the specified financial measure. Another common example is the measure is not quantified in the executive compensation disclosure, so the disclosure requirements under 52.112 would not be required to be included in this document. But if the measure is quantified in another document, such as the issuer's MD&A, then the 52.112 disclosure requirements apply, and the non-GAAP financial measure disclosure set out in Section 6 of the rule would need to be included in the MD&A. Now that we have gone through the scope of 52.112, I wanted to address the questions around whether disclosure for each specified financial measure is required in every document. The answer to this is no. The instrument allows an issuer to incorporate by reference certain disclosures if the reference is made to the issuer's MD&A. The MD&A that is being incorporated by reference must be filed on SEDAR before or simultaneously with the document that includes the incorporation by reference. For example, if an issuer is filing an annual information form that includes a specified financial measure and the information is incorporated by reference to the MD&A would have to be filed before or simultaneously with the annual information form. The disclosures that can be incorporated by reference include the composition, usefulness, reconciliation for current and comparative periods, and an explanation for any changes in labels or composition if applicable. If permitted to incorporate information by reference, an issuer must include a statement indicating that the information is incorporated by reference, specifying the location of the information in the MD&A, and stating that the MD&A is available on SEDAR. When specifying the location of the information in the MD&A, identify the specific MD&A, including the MD&A's reporting period and specific section or page reference. The incorporation by reference provisions would not be met if a general hyperlink to the MD&A is provided without specifying where the disclosure is located within the MD&A. For example, this statement would meet the requirements as it indicates that the information is incorporated by reference, specifies the location where the information can be found in the MD&A, including the page reference and reporting period of the MD&A. Lastly, the statement discloses that the MD&A is available on SEDAR. So that brings us to the next set of questions we have been receiving around the application of 52.112 and what needs to be disclosed and how to provide that disclosure. Anne-Marie will now go through a few examples.
Thanks, Nicole. On the slide, I have a snapshot of the disclosure required under 52.112. I don't plan on going through this in detail today. For each type of specified financial measure in detail and the disclosure requirements that result from disclosing a specified financial measure. But what I want to highlight here is that there are a total of 10 disclosure attributes, as you can see in the boxes in gold on the left. And these 10 disclosure attributes are applicable to non-GAAP financial measures. As you move to the right of the table, there are less and less disclosure attributes that apply to the different specified financial measure categories. For example, total of segment measures, only 4 out of the 10 disclosure attributes apply. And moving to the far right of the table, only the labeling and composition apply for supplementary financial measures. Thinking about these disclosure requirements, I have a non-GAAP financial measure disclosure example to go through. In this case, adjusted EBITDA meets the definition of a non-GAAP financial measure as it is not disclosed in the financial statements. It is not a ratio. It depicts historical performance, and its net income or earnings adjusted for interest, taxes, depreciation, amortization, and non-recurring events. As it meets the definition of a historical non-GAAP financial measure, the 10 disclosure attributes listed in the box on the right of the slide are required. I'll highlight a few of these disclosure requirements, starting off with labeling. For labeling, here the label of adjusted EBITDA is appropriate as it can be distinguished from the financial statement line item net income, and it can be distinguished from the commonly used measure EBITDA, as this measure has been adjusted for non-recurring items, in addition to the common adjustments made in calculating EBITDA, interest, taxes, depreciation, and amortization. The issuer should then ensure that the non-GAAP financial measure is identified as such and provide a cautionary statement that it does not have a standardized meaning and may not be comparable. And the prominence requirement and the requirement to disclose the most directly comparable financial measure presented in the financial statements applies throughout the MD&A. And as the MD&A is a document which requires the disclosure of comparatives, unless impracticable to do so, this example, the table presents the comparative period balance for net income loss as well as adjusted EBITDA. Other disclosure attributes I want to highlight are the explanation of composition of the non-GAAP financial measure, and this is simply a description of how the measure is calculated. An explanation of how the measure is useful and the additional purposes, if any, for which management uses it. The reconciliation to the most directly comparable financial measure. In this example, the comparable measure, net income loss, starts off the reconciliation. However, an issuer can start a reconciliation with either the non-GAAP financial measure or the most directly comparable measure, as long as the reconciliation presented is understandable and consistent. And lastly, if there has been a change in the label or composition of the measure, provide an explanation for the change. In this example, a footnote has been added to provide the explanation for severance costs being deducted from the prior year. I'll pass it over to Nicole for a forward-looking example.
In the example that Anne-Marie just walked through, we established that adjusted EBITDA is a non-GAAP financial measure. So if the issuer disclosed adjusted EBITDA for fiscal 2022 in the 2021 annual MD&A, the future-orientated adjusted EBITDA would meet the definition of forward-looking non-GAAP financial measure, as it depicts future financial performance. So the 4 disclosure attributes listed in the box on the right would be required to be disclosed. First, the issuer should ensure that the label is appropriate. Here, the label of adjusted EBITDA is appropriate as it is the same as the equivalent historical non-GAAP financial measure. The issuer should then ensure that the equivalent historical non-GAAP financial measure is disclosed. In this example, historical adjusted EBITDA is included in the table as actual results for the past year. Next, provide a description of the significant differences between the non-GAAP financial measure, that is forward-looking information, to the equivalent historical non-GAAP financial measure. There are various ways to do this, but this example provides a bridge analysis to the historical non-GAAP financial measure for the equivalent historical period. When a reconciliation or bridge analysis is included, it is important to remember to disclose all significant differences. Additional items may need to be included. Lastly, the issuer needs to ensure that the measure is not presented with more prominence in the document than that of the equivalent historical non-GAAP financial measure. We only have an excerpt of the non-GAAP disclosures in this slide, and we remind you that prominence is assessed each time the non-GAAP financial measure is used and in each document. Prominence is an area where we have been getting questions, specifically in regards to what prominence of different specified financial measures is measured against. Anne-Marie?
And to help out with this prominence, these prominence inquiries that Nicole mentioned, we have an example based on a recent inquiry. In this example, the specified financial measure is shown in the blue box, and the specified financial measure should be presented with no more prominence than the measure indicated in the box in yellow. For the first example on the left, both non-GAAP financial measures and total segment measures require that they be presented with no more prominence in the document than that of the most directly comparable financial measure. So if an issuer were to disclose an EBITDA measure as a historical non-GAAP measure or as a total of segments measure, this adjusted EBITDA measure should be presented with no more prominence than the most directly comparable financial measure, in this case, net income loss. Moving right to the next example, for a non-GAAP financial measure presented on a forward-looking basis, the prominence requirement is that the forward-looking non-GAAP financial measure be presented with no more prominence than its equivalent historical non-GAAP financial measure. So for expected EBITDA for fiscal year 2022, the prominence of this measure would be measured against EBITDA for the equivalent historical period, fiscal year 2021. For non-GAAP ratios, the prominence requirement is measured against similar financial measures disclosed in the primary financial statements to which the non-GAAP ratio relates. So for EBITDA per share, a similar financial measure would be earnings per share as disclosed in the issuer's income statement. For capital management measures, like non-GAAP ratios, prominence is also measured against similar financial measures. And what I want to highlight here is that judgment may need to be applied in determining the similar financial measure. As an example, when an issuer discloses a capital management measure interest coverage ratio, which is calculated as interest or net income loss divided by borrowing costs, the appropriate options for the similar financial measure to interest coverage ratio might be finance costs, borrowing costs, otherwise known as interest expense on the income statement, or debt as disclosed on the balance sheet. So those were 4 examples of how the prominence requirements differ for different specified financial measures. But I also want to take the time to address some questions we've been getting on the overall prominence requirements. One recent question was asking if the prominence requirements have been met, if the most directly comparable financial measure has been disclosed before the non-GAAP financial measure. To answer this, simply disclosing the most directly comparable financial measure before the non-GAAP financial measure may not meet the prominence requirements. You need to consider the level of the discussion and the use of the non-GAAP financial measure when looking at and in assessing the prominence requirements. For example, prominence requirements may not be met if an issuer emphasizes the specified financial measure over its GAAP counterpart, either through bigger font, bolded text, or in a chart including just the specified financial measure. Another example might be where an issuer has more prominent level of discussion and analysis of the specified financial measure in its disclosure document, or where multiple specified financial measures are being used for the same or similar purpose and obscure the issuer's GAAP measures. Overall, prominence is a matter of judgment, which should consider the overall disclosure of both the specified financial measure and the GAAP counterpart, and consider the facts and circumstances in which the disclosure is made. And that covers off the 52.1.12 section of today's presentation. If you have any questions on 52.1.12, please reach out to either Cheryl or I in the Office of the Chief Accountant. We would be happy to help with any questions that you have. And the Office of the Chief Accountant are currently planning other information sessions where we will be doing a deeper dive into some of the FAQs we have been receiving in areas such as total of segments, reconciliations, most directly comparable financial measures, and other areas. We'll provide information on these sessions on the ASC website or through email.
Now to conclude the presentation part of our session today. I will provide a quick regulatory update, including recent guidance that's been published and the high-level overview of projects that are currently underway at the CSA. The ASC issued a number of reports and publications during the year, but I wanted to draw your attention to these recent publications as they may be useful when preparing your year-end reporting documents. The last 4 items relate to reports issued by the ASC on an annual basis. These reports are created to provide timely and relevant information for reporting issuers and other market participants. We currently have a number of projects in progress at the ASC and across the CSA. In addition to the projects that Denise discussed in her opening remarks, I wanted to highlight these 3 ongoing projects as they will have the biggest impact to those of you attending today. You can also refer to the Corporate Finance Disclosure Report for a more in-depth description of the Reducing Regulatory Burden project. I would like to end the presentation by providing a list of available resources, which will allow for you to stay up to date on recent and upcoming projects. You can either subscribe to receive weekly updates using the link provided or follow the ASC on Twitter and LinkedIn. We will now open up the floor for any questions that you may have.
Great, that was a lot of content. Okay, we have quite a few questions. I think we have about a little less than 10 minutes. So let me see here. We will start with Chris, I think here, or actually, you know what, Anne-Marie, I'll start with you. I have a non-GAAP financial measure question. Can a component be from several financial statement line items?
The answer to that is no. A component is a component of a line item, one line item, or disaggregation, otherwise known, another term that it's known as. So if it's from several financial statement line items, that would be essentially adding up two financial statement line items, and that would be a non-GAAP financial measure, subject to the requirements in Section 6. A component would not be a non-GAAP financial measure itself, but it may be subject to the supplementary disclosure requirements in Section 11.
Thanks. All right, so Chris, this one is for you. Our company has not yet generated revenue, but we have signed letters of intent and purchase orders that we expect to materialize. So how can we communicate this information in compliance with, securities laws and not being considered promotional?
Yes, thank you for the question. We find this disclosure a bit concerning when it artificially inflates an issuer's share price. This is a material financial outlook that does give guidance to investors on the expected amount of revenue and within a certain time frame. As such, the Part 4B of National Instrument 51-102 does apply, and we do expect the material assumptions as well as the risks of orders not materializing to be disclosed. Also to highlight, if actual results differ from the forward-looking information, where we expect disclosure and discussion of those material differences, including the timing.
Okay. Thanks, Chris. All right, let's see here. Bawani, if we have graphs and charts in our corporate presentation on our website, should those same graphs and charts be included in the MD&A?
Well, as long as narrative disclosures are provided in the MD&A that is similar for explaining the charts and graphs, then it is not required to provide, for the issuer to provide the same graphs and charts in the MD&A. However, the issuer has to be mindful, and if they find it material to include graphs and charts for better explanation in their corporate presentation, then they need to question themselves whether, it is material to provide the same graphs and the charts in the MD&A.
Okay, thanks. All right, Nicole, we haven't asked you one yet. Okay, here's a question. It says, if I include a forward-looking non-GAAP financial measure for fiscal 2022 in a news release filed before my December 31, 2021 annual filings, is the 2022 FLI measure subject to 52-112?
So no, it wouldn't be applicable to 52-112 because 52-112 is initially adopted after their annual filings so it'd be the December 31st, 2021 annual filings. So it'd be when they file their MD&A or the earnings release. Anything subsequent to that would be applicable to 52-112. So anything filed before would not be, including the FLI.
Okay, thanks. Anne-Marie, we've got another for you. This one seems similar to the other that we asked, but are individual segment measures such as EBITDA disclosed for one segment subject to 52-112?
Yeah, and we've been getting this question a lot. Essentially, this would be an EBITDA measure that's disclosed in the financial statement notes. It wouldn't be a total segment measure because it's for one individual reportable segment, and it's also not a non-GAAP measure because it's disclosed in the financials. So essentially, we wouldn't require any 52.112 disclosure for this measure.
Okay, thanks. Let's just see what else we have. Bawani, do the bar criteria regarding multiple investments in the same business and acquisitions of related businesses also apply to venture issuers? Oh, Bawani, I think you're on mute.
Yes, it definitely applies to venture issuers using the 100% applicable to venture issuers.
All right, thanks. Chris, another question for you. It says, we believe our company is now carbon neutral. How can we disclose this information in a manner that the ASC would be comfortable with?
Yes, thank you for the question. We typically find this disclosure to be promotional in nature when it cannot be substantiated or verified. And we do expect material factors and assumptions to be provided when making this disclosure. How carbon neutral is defined, how it was calculated, inputs and offsets, as well as if there's a certain set of environmental standards followed that allow a company to assert they are carbon neutral. Those could all be material information to support the disclosure.
Anthony, do we have any more questions here? I'm just looking on our, it seems like we've answered the questions that are here. There was one, let me see. No, it looks like we've covered those. Here's one for you, Bawani. Another one for you. Can you provide us an instance where an acquisition would be considered an asset acquisition under IFRS, but would be a business acquisition under securities law?
The determination of whether an acquisition is an asset acquisition or business acquisition needs to be determined on a case-by-case facts of each acquisition. But in an instance that comes to my mind for this difference is where an acquirer, applies the concentration test under IFRS 3 and determines its oil and gas acquisition to be an asset acquisition under IFRS 3. However, the same acquisition may be considered as a business acquisition under securities legislation if it meets the interpretation of business under Section 8.1 of National Instrument 51-102. So this is an instance that comes to my mind.
Okay. Thanks, Bawani. All right, I think that covers all of the questions that we have. So. There's all the questions have made it through to me. I think we may have some other questions that haven't made it through to me. So if that is the case, then we will try to deal with those questions offline and get back to people. My apologies, they're coming through on my end a little bit slower than then I guess they're getting sent in. So we will try and circle up and respond to those questions. So thanks very much. I think that's the end of this session, and we'll take a quick break and we'll be back with Tanya and Amanda and the 51-107 discussion.